Good evening, everybody. I'd like to welcome you to what is our third planned Integrity 365 webinar. Tonight's instalment is on AIM, inheritance tax and business relief, with our guest speaker, Adam Greaves, AIM Investment Director at Investec. Adam's got significant experience in this area, and I must say we're very, very grateful to him for giving us and yourselves some of his precious time. Also joining us on the call is Mike Kempster, Business Development Director at Investec, and he's going to say a few words before Adam gets to the heart of the matter, the subject in hand. As I said, it's the third instalment in the series of the webinars that we are running. Some of you may have attended our previous ones. The first one was a fascinating presentation on sustainable investing. Second, how to maximize income through construction of your portfolio. If you've not seen either of these and it is something of interest, feel free to reach out to your integrity advisor. Pop over to our website where you'll find the links. Alternatively, if you want, you can send me a message in the chat function here. I'm more than happy to send you a link over. Firstly, let me introduce myself for those who I've not met before or who don't know me. My name is Tim Jones. I'm the Sales and Development Manager here at Integrity 365. So as I said, welcome. I'm delighted to be hosting the webinar. We want to bring this a key client consideration to life, how AIM and business relief can help individuals, clients. Just some housekeeping for you. Nobody can see anybody else on the call. Nobody can hear anybody else on the call. The only people you can see and hear, quite importantly, will be Adam and Mike. But there is an opportunity if you want to ask questions. There's a functionality at the bottom of your screen. If you hover your cursor over, you'll see there's a chat functionality or Q&A, raising of the hand button. Adam's kindly agreed to answer some Q&As at the end. We've had some questions already submitted from clients who couldn't be with us tonight, and he's going to maybe cover some of these during the presentation, but we have scheduled time in for taking questions from yourselves. So Mike, without any more further ado, over to yourself.
Many thanks, Tim. Good evening, and thank you very much for taking the time out of your schedules this evening to join the Integrity 365 webinar, to hear from myself and Adam at Investec. So as Tim kindly introduced, I'm the Business Development Director at Investec, and I work with your advisors at Integrity 365, providing support and relationship management as one of their strategic partners, providing investment and banking services. So before Adam goes into as Tim said, the heart of the matter and talking about the inheritance tax and AIM and how the two go together, I wanted to just provide a short summary of who Investec are, the key services that we offer, and explain one of the facilities that we offer that really goes hand in hand with our bespoke investment management and banking solutions for high net worth individuals. I'll be speaking for around, Adam will continue the presentation on AIM and inheritance tax planning. So essentially, firstly, let me explain who Investec are, if you don't already know and haven't heard us. So we're part of the Investec Group, which is a PLC, a global bank that's headquartered in London and South Africa. And within the group, we have a specialist private bank and a wealth management business that serve the needs of individuals and companies. The business Investec was founded in 1974, and we've grown through acquisition and organic growth across businesses in the banking and the wealth management sector. As I said, we work in partnership with advisors like Integrity 365 and clients, and we provide many different investment management services. And we are trusted with over 41 billion of client funds under management across 20,000 clients. We're well placed to support advisors and their clients through our local presence and network of 15 offices. So if you're in one of those towns, you might well know of the office or whereabouts it is. So enough about who we are. In terms of what we do, the three key services that our bank and wealth offers clients is investment management, private banking, and corporate services. Investec offers a range of lending, cash, banking services for clients that typically have an income of 300,000 per year and 3 million in assets. But that criteria only really applies to some services that we offer for clients. But there are also services available, the one which I'll highlight today, that are available to clients through their advisors, such as Integrity365. And if you do want to find out more about this and how it might be suitable and whether this is something that you could benefit from, we just urge you to speak to your advisor at Integrity365 to really kind of help understand what your circumstances are and whether the optionality that Investec could offer might be beneficial to you. So the service that I wanted to talk about today is portfolio lending. This facility, as I said, goes hand in hand with our bespoke investment management service, and it's essentially a loan that is secured against your investment portfolio. So when an opportunity presents itself, the ability to have options and think fast and move quickly is very often a decisive factor in terms of the successful outcome that you might be able to achieve. And our portfolio loans are designed to offer quick, flexible, cost-efficient way to borrow against your investments. Whether you're looking to secure property, want to reinvest into a business or have an urgent opportunity, or looking to simply diversify your portfolio, our first reaction as a team working with the advisors at Integrity365 would be to understand your situation and find out how we can help. So, in case you haven't heard of portfolio lending, what is that? With portfolio lending, there are two ways that a client can utilise the loan. The funds from the loan can either be reinvested into your portfolio, which increases the capital sum invested, potentially enhancing returns, or even allowing an investor to take advantage of buying opportunities that market conditions might present. And the second option is to use the loan for non-reinvestment purposes. So what do I mean by that? The loan is still secured against your investment portfolio, which remains invested. The funds are then transferred to you as the client, and from here you can decide how you want to utilise the funds for any legal purpose of investing or expanding your portfolio. So, I mean, I think just some key features just to kind of highlight here. It gives you options. You can raise funds without needing to liquidate your portfolio, but might have high capital gains or just inflexible in terms of how you want to release the equity out of your portfolio. It's fast to get decision and easy to access, and the repayment terms are flexible, so we can take into account your circumstances. And the loan to values that are available will depend on the risk profile of the portfolio. For example, if you're a medium risk client, let's say might have 60% invested, 60-70% invested in equities, probably looking at lending a maximum loan to value of 60% of your portfolio. Just before I go into a short case study and finish off and hand over to Adam, I think it's just a few eligibility criteria that you probably need to be aware of, and is really what I would say is something you should discuss with your advisor at Integrity365. But depending on your circumstances, clients need to be able to obtain a certificate or a statement of high net worth from their accountant. Depending on your structure of your arrangement, whether it's in a corporate entity, an offshore bond, a general investment portfolio, or an ISA, there may be some legal fees involved if we are lending to a corporate structure or a trust, for example. If it's an ISA or personal account, it's no arrangement fees. And there are minimum loans depending on the amount you have invested and what the purpose is intended for in terms of that. I think the only purpose that we cannot lend against portfolios for is renovations of property. So if you're looking to renovate your main home or a holiday home or a kind of extension or something like that, it wouldn't be available for that kind of facility. But if you wanted to acquire a buy-to-let property, for example, this is fine because that's exempt from a business purpose, and that's a regulatory policy, not Investec. That's just the rules of it. It is under the Credit Consumer Act as a high net worth, exempt from the Credit Consumer Act as a high net worth individual, so it is only available to clients that meet that criteria. So just quickly, last few minutes for me just to finish up. Why would you look at a portfolio loan? So let's say we have a client that has £1 million of investable wealth. There's a statement of high net worth, and the client's looking to diversify their portfolio and acquire a buy-to-let property worth 500,000 in a prime location. They could use the cash from their portfolio, they could put down a deposit and take out a buy-to-let mortgage for the rest. which has set repayment terms and criteria that the lender will want you as the buy-to-let investor to meet. And this can sometimes be inflexible. Portfolio loan means that the £1 million can be invested. You can borrow as the client 500,000, which is secured against the personal portfolio. There's no reset payment terms. It's flexible options, so you just essentially service the interest on the loan. You have more flexibility as the investor in terms of the property that you want to acquire. And if you do want to develop first before renting out, you have access to the funds with few restrictions that a buy-to-let mortgage might not be able to offer to allow you to acquire those opportunities. Essentially, I mean, let's kind of look at fast forwarding that. You've got £1 million that's then invested in a portfolio focused on growing that wealth and paying down the interest of the loan. A buy-to-let property generating income and long-term potential growth without a mortgage. And the loan has no set repayment terms, so it can be repaid at any time. It just gives you options, it just gives you extra flexibility. And as I say, it is important that you seek advice from Integrity365 and guidance from the advisors as to the suitability of a portfolio loan. Is it the right option for you? And if you would like to understand more and how it might benefit, just get in contact. And if required, they can arrange a meeting with us at Investec and with our private banker, Kate McGee. And she's the dedicated private banker for the Integrity365 relationship, and we'll be able to discuss it further with you. Finally, for me, thank you very much for listening, and I hope that's kind of triggered off some ideas and some food for thought for some conversations with your advisors. Without further ado, I will hand you over to Adam, who will continue on the presentation.
Thank you very much, Mike, and thank you, Tim, and also thank you to Integrity365 for letting us present tonight. Good evening, everybody. So I'm just going to spend hopefully the next sort of 30 minutes talking about everything AIM, inheritance tax, and business relief. So the first slide here I've got here is really about, I've put a few learning points in here. So not necessarily learning points, could be also revision points too, but just generally looking at the alternative investment market and how it can help your clients or yourselves in terms of mitigating inheritance tax liabilities. Explain the rationale why AIM shares adhere to business relief against the main market. So why is it the AIM market? There's something special about the AIM market that lets or has the ability to have the inheritance tax relief. And then I'm sort of going to show you about the AIM, the evolution of AIM from sort of the Wild West days to where we are today, sort of a highly regulated market with very fast growing companies, but also very large companies that could be on the main list and could be in the FTSE 100. When I go through a little bit of our criteria, I'll speak about some of the companies listed on AIM, which you may or may not know, some names you may recognize, and touch on also our ESG criteria too. But we feel it's very much a stock pickers market. So again, it's a very high risk market when you look at the smaller companies, but you can reduce that volatility by carefully selecting the quality, the type of companies that we're investing in the plan. So just looking at IHT planning in AIM, the business relief, the HMRC define as unquoted companies, and any companies listed on AIM are considered unquoted. So anything on the main market, the FTSE 100, 250, and those indices are considered listed, whereas those listed, those that are on the AIM market are unquoted and adhere to business relief before other criteria. So the benefit of the inheritance tax relief is holding these companies for 2 years. So it's reducing that PET, the potential exempt transfer or the gift of 7 years down to 2 years. And then you have to hold these companies at the time of death. So as long as you've held them 2 years or qualifying assets for 2 years, it doesn't have to be the same companies, and I'll talk about that in a second. But you have to hold them at the time of death, then they should adhere to business relief and be out of your estate, passed on to your beneficiaries. So the replacement provision in the Act means that the companies we own day one of that 2 year time horizon doesn't have to be the same companies we own at day Z or whenever that might be after the 2 years. So as long as we sell a qualifying company and reinvest in the qualifying company, that timeline continues and you continue to adhere to business relief. The other criteria that I'll touch on in a little bit of time, but mainly as long as the companies are trading companies, they would adhere to business relief and listed on AIM. There's no maximum gross limits you can invest in these, unlike EIS and VCTs. And also you can put these companies in ISAs. So the benefit of putting them in an ISA is there's no income tax, no capital gains tax, no stamp duty, because there's no stamp duty on AIM shares, and also no inheritance tax. There's a lot of relief you get through investing in AIM shares within ISAs as well. So in terms of the suitability, what type of clients would this be a suitable plan for? Those that have got ill health or those that are potentially not going to last the full 7 years could reduce that down to 2 years by sheltering some of that within AIM companies. Generally, high net worth individuals looking for something different, they could have a discretionary portfolio, but then they could have exposure to the smaller companies and they've got the additional benefit of that tax break. If you've got a sale of a family or a private company, you've got business relief assets that you sold, and that cash you generate from the sale of your business, that's already business relief. So you roll that into an AIM portfolio, will continue those assets or some of those assets to continue to be business relief and therefore have the IHT break. The difference between the AIM portfolio and some of the others is that you have the liquidity and you have the ability to access this cash if you ever need it. So it's held in your own name or your ISA. So if you ever needed to dabble or take anything from these portfolios, the cash can be raised quite quickly as a normal portfolio. And again, most of our, unfortunately, most of those that have died within the plan, there's a lot of time that these are liquidated assets that are used in other areas of their estate not covered from inheritance tax liabilities. So they sell this, they have a generated significant wealth, then they use that to other areas of the estate or generally to pass on to beneficiaries. So when I was talking about business relief and AIM, it addresses the funding gap. And I think this is one of the key things for treasuries, that the UK is considered an entrepreneurial type country. So looking after the smaller companies, those that are trying to raise the capital on the alternative investment market. And I think that's one of the questions that comes up quite a lot. And I'll sort of touch on, I think it came up in the Q&A or pre-submitted questions, is what happens if business relief is pulled from the Treasury offer and from HMRC? And really, because we have the entrepreneurial spirit, we can't see the evolution of that taking hold in full effect. And the amount of inheritance tax liability that the government takes on an annual basis is very, very low in consideration to corporation tax and other income taxes and so forth. So it's a very, very small tax in terms of overall GDP of the country. But also, if you stop the business relief for those investing in these smaller companies, you're choke holding those future businesses of today, those companies that are employing significant people around the UK and overseas. So you're sort of strangling their growth potential. So in terms of AIM shares, they're unquoted if they're listed on the AIM markets. That gives it a tick for inheritance tax relief. As I say, the shares must be trading businesses, so we can't invest in real estate investment trusts or other investment trusts because they're not dealing in trading or making and holding investments. And there's always some comment we get back to say this company holds land or this company holds significant cash. There is potential that isn't adherent to business relief if they hold too much cash, but if it's used in the day-to-day business or the working capital of the day-to-day business, then it should continue to be a business relief. Like I say, that's that last point on excluded assets. So as an example, if a company had a significant amount of land just held there as a fixed asset on their balance sheet, that potentially would be an excluded asset. So if HMRC looked into that company quite closely, much of that investment might not adhere to business relief. But since our inception in 2002, we've never had a company come back to us or HMRC come back to us questioning one of our holdings. So then you look at the difference between the main market and AIM. So why do companies invest on AIM and not the main market? The main market is very expensive. You're directly regulated by the FCA. You have to adhere to the listing rules. So therefore, you have to have a significant compliance function. There's a lot of cost in the listing, the cost of listing itself through an investment bank. Whereas if you're on an AIM, you basically have an intermediary. You are the company listed on AIM, but you have a nomad, which is a nominated advisor, such as ourselves. Investec Bank are a nominated advisor, and others such as Numis and Peel Hunt. And they act basically as your intermediary between the FCA, where they are regulated, and yourselves. So any listing rules, any prospectus that goes to the market, they do on your behalf, and they're basically your intermediary to make sure that you adhere to all the AIM rules for companies on the junior market. So as I said there, the prospectus approved if you're on the main market from the FCA. So this is something you have to prepare or through one of your intermediaries, and it's adhered to the FCA. You have to have 3 years revenue record and 25% free float. A lot of the companies that are coming onto AIM, a lot of companies we've seen generally or might not have those full 3 years. They might not want to have 25% free float day one. So again, that could limit the ability for these smaller companies to be listed on the main market. Whereas if you're looking at AIM, as long as you've got a nominated advisor on a nomad, they produce your admission document, but there's no trading record. Apologies, this is in the screen. No, I can't get rid of that. Hide. Okay. There's no trading record necessary, so it can be a very young company and there's no free float. So you can have very, very little shares on the market. These are the type of companies we don't potentially look at in our plan, but it gets them listed, it gets them a little bit of kudos and some external money to be invested in those companies. So it's starting their growth potential as a listing on AIM and hopefully are the bigger, larger businesses of tomorrow. So in order to maintain a listing, we're sort of talking about how you get the listing. You have to have a nomad at all times. So you can change a nomad, but you have to have a nomad or a nominated advisor. Your financial reports for us as investors, we have the conversations with the executive teams, but you have to report at least half yearly. A few of our companies do 3 months or quarterly updates, but the annual accounts, again, will have to be within 3 months and they're audited annual accounts. There's class tests, so shareholder permission for reverse takeovers and disposals. So again, we get those conversations. The exec teams comes to us. If there's a significant bid or if there's a significant acquisition, they would come to discuss with us because we're quite large shareholders in quite the companies that we own for advice. So we're constantly speaking to these boards to get the best for as stewards for our clients' money. Corporate governance, comply or explain, website disclosure up to date. But again, trading liquidity, the nomad would have liquidity, the brokers have liquidity, and there are research coverage. So there's lots of smaller type niche companies such as Peel Hunt, such as Investec that cover these companies. So there are a number of analysts that cover AIM companies too that assist in our research. So looking at the evolution of AIM, the top chart here shows sort of what the market looked like in '95. Very little number of companies, very little market cap. And you can really see before the financial crisis in 2008, there's a lot of companies that came onto the market in that 10 years. From basically less than that, or around about 100 to nearly 1,400 type companies of quite significant market cap. Sorry, not as much market cap, but those sort of companies, they're the Wild West companies, the ex-profits, the oil miners, the gold miners, the technology companies that didn't make any money, they were highly speculative. They've gradually either grown and have done very well, or they've gone away. And you can see from the sort of last 15, 16 years that the number of companies listed on AIM is reduced. And that's a number of twofolds, that the issues are less than the number of companies leaving through reverting to the main listing, through being acquired, through not surviving, and again, losing your listing on that. But you can really see there, the orange line is significantly grown in the last sort of 5, 6 years. The size of the companies, the market cap of the overall market there is around about 140 billion as at the end of the year. Whereas the only number of companies listed at this point in time was about 800. So the companies, as you look at the bottom chart there, the companies are getting much larger, they're getting more mature, and they're surviving. So you're getting a lot of growth through these companies. They're established businesses, and they're sizable now. So they're very investable, they're very liquid, some of the companies we invest in. So we're very fortunate. There's a lot of good companies in our market to build a plan out of. So we're out touching on the AIM market again. The left-hand side, this is to the 30th of June, so a little bit more updated. The left-hand side, the dark blue table shows the market sort of disseminated into three tiers. So a billion plus is 40% of the market, and that's 25 companies. The bulk of the market there, you can see 60% is between a wide market cap of 50 to £1 billion. Around about 400 companies there, and less than 50 million market cap. Still, there's a lot of companies in that smaller cap, and that's basically 50% of the companies, number of companies, but only 5% of the market cap of the market. Then the light blue, we sort of look at, okay, fine, we've looked at the market. What is our first stage of screening? What's our first stage of our criteria selection? We only look at companies minimum 100 million market cap, and for that we believe gives us adequate liquidity for our clients, for our sort of 2,500 clients that we currently manage for, that we can buy the shares, we can trade in those shares for all the clients if we wanted to. This brings it down from the 830 companies or 826 companies there to 294. So our initial screening, without looking at any business relief eligibility, is 300 companies, and that's basically 90% of the market cap of the market. So there's a lot of companies that form a very, very small of the market cap of the overall market. I think probably everyone is aware or has products from the companies. ASOS was the largest company at the end of June 2021, 5 billion market cap. They had some results since that time, and I do believe that market cap is now near 4 billion. So it can change quite a lot, and that's the sort of volatility we can see on the market. But what the last point there on the bottom right hand side, it really shows the liquidity of the market. It's a very mature market. There's a lot of money coming in and out of that market. There's a lot of equity raises in 2020. There's a lot of new issuances in 2020. So 83 billion pounds was traded in the full year of 2020, even with the crisis. So you can really see that that's basically 2/3 of the market cap was traded last year. And that's a significant increase, a third increase from 2019. So again, a lot of liquidity, a lot of investor cash comes into the market. I just wanted to touch on one slide on ESG. It's one thing that our clients and advisors are talking to a lot about, to say, what do you do for ESG? We have our own ESG statement, but mainly our first level of screening after we looked at the 100 million market cap is the negative screen. So we do not invest in any non-business related excluded sectors such as investment business and property business, as I said previously. Also, minerals exploration and petrochemicals, those companies or the gold miners that did very, very well last year, sort of a risk-off environment, they don't adhere to business relief. And also those with social governance impacts, such as payday lenders, tobacco, and also the governance, which is one of the sort of easiest subjects to cover on ESG, as we've been doing it for a very long time, is that those majority stakes where the CEO owns a significant amount of the equity within the business. So those with low free float. If we wanted the seat at the table in the AGM, if we wanted to vote and make a difference, we couldn't if the CEO had that significant majority stake. So those are the sort of companies we screen out on ESG grounds. Those with positive weightings, we're having a lot of conversations. We're going through this significant learning process of the questions to ask and basically the answers we get given from the exec teams and the boards. But those that are really looking to make good in the environment, those that have a plan for carbon zero, those are looking at renewable energy or workforce policies. And even though there isn't a significant or requirement to have a governance statement in your accounts, a lot of them apply to the smaller companies' governance structure, and so that is the best policies or the best practices for companies generally. So the board structures, we have the conversations that if the board's aging or if there's a number of seats on the board that have been there for 10 years plus, this is now considered poor governance. So we're having the conversations to say, maybe it's time you refresh your board. Maybe it's time you look at a new chairman that can bring new ideas to the table. A lot of conversations we're having at the moment is around LTIPs or the long-term investment, the CEO pay is generally in the public eye at the moment to say, are they being paid correctly or attractively to retain them, but also in the best interest of shareholders. So there's a lot of conversations we're having at the moment around ESG, and that's the sort of the qualitative side of our screening from the quantitative side of the numbers that we spoke about previously. As I sort of said, we engage with boards and we vote all our shares. We're good shareholders. We have between sort of 2 to 11% equity in these companies we invest in. So we do have a voice at the table. So we make sure we vote in those, and we don't always vote in line with what the boards are recommending. We use an external company called ISS that give advice in terms of how you should vote, and we would report, we would digest and review that report, but make our own decisions at the end of the day, as we have the better knowledge and those communications with the board. So just a few example companies before I touch into a little bit more of our criteria, the next step down. These are the type of companies you may recognize. So YouGov, if you're into your political polls, you'll probably see that during the election, it's all powered by YouGov, and they have basically a data analytics tool behind them where they have a panelist of surveyors. So if you signed up to YouGov, you'll probably get a daily email to say, fill out this next survey. So they're really looking at the per pound spend for their clients to really go to earning or to generating those revenues. So it's that data analytics side. And for us, we've invested in those for a long time, and we've done very well out of them. This year alone, we've taken significant profit because the share price valuation on this one is very, very high. So we've seen this wave up, but we've, as I'll talk about later, is to take the profit off of that and to reinvest in the other areas of the plan. Another company, Strix, may not be as familiar to everybody. Strix do the heating element technology within kettles. So if you're at home, you probably are. If you go into your kitchen, hopefully after this presentation, and lift up your kettle, you'll probably see the heating element underneath is a strict product. They have 70% global market share of these kettles. So these are the type of businesses we like. They've got a wide moat, they've got a quality product, and they're basically in all the OEM, the original equipment manufacturers such as DeLonghi or Bosch, and they supply the heating elements to all these kettles. This is a relatively recent investment for us for a number of reasons, but again, since we introduced it into the plan, probably about 18 months ago, it's done very well for us. And another company completely out there, which you may or may not have heard of, you may have read a little bit about it, but they do a lot of photonics and optronics. It's Gooch & Housego. If you looked very closely at the Mars Perseverance rover, there's a laser that Gooch & Housego produced that are on that, that's on that rover. And they've also had recent lasers and optics that have gone up into space on the Starlink system. So they basically produce products, lasers and photonics for the most harsh environments in the world. They do a lot of stuff for undersea cabling, so a lot of decouplers to make sure the fiber cabling for deep undersea communications, they provide those as well. So again, it's a very specialist type business, but one of the best businesses in its own sector of what it does. This is one of the companies that we've owned since inception of the plan in 2002. So we've matured with this business the whole way through, and it's one of the businesses that I look after. I have a very good relationship with the board and the executive team there. So that's sort of a few companies. So then going back to our criteria, we've looked at the 100 million minimum market cap. We've then looked at an ESG screen, and then we really look at the sort of qualitative aspects underneath. So again, an experienced management team. We like someone who's been in the seat for some time. We don't like a constantly changing board, constantly changing management team. We like that maturity and stability within the top team of these companies. Despite the number of previous slide that I mentioned that you can list on AIM without a trading history, we like them to be trading at least 5 years. Then they have an establishment, they have a customer base, and quoted for at least a year. So we don't invest in IPOs. Ultimately, when a company comes onto the market, it depends on the route of exit. So if it was owned previously by venture capital or private equity, they look to get the most money for the investment. So they look to get the biggest bang for their buck, which may not be the best price for that company today. And maybe there's something in the prospectus that looks good that may not look good as the months progress into their listing. And also after a year, they're a mature business now. They've gone through a whole cycle of launching their financial accounts and discussions with shareholders. So it's sort of learning as well as maturing how to have a relationship with shareholders as they enter the market. We're like a company with distinctive capabilities, and an example, as I said earlier, was Strix in terms of their barriers to entry of their product when they have that massive global market share. A proven financial track record. Every single company that we invest in has to have a yield of some sort. We think that excess cash the management can pay away to shareholders shows good cash management. Like it doesn't have to be a significant yield, but if they can pay excess cash to shareholders, that we think that is, yeah, as I said earlier, very good cash management and management generally. We don't take a lot of finance risk, so we have a sound balance sheet. A lot of our companies are net cash positive, and those that have a little bit of leverage is due to acquisitions, recent acquisitions that we've spoken to them about and given them the green light. So again, they may have some leverage at the moment, but they actively pay this down through good cash generation and good cash conversion. And the other thing we like is potential catalysts for change. So sort of going back to my Strix example, they're the global leader in heating elements in kettles. And then the other side of it, they've recently bought a water purification business. So they're looking after the kettles, the heating element, but now they're looking after the water that goes into the kettle to prolong the life of the kettle. This technology currently is used in sort of pig farms and purifying water in China and in Asia, but it's really coming to human consumption too. And they do have a product for human consumption on Amazon currently. And again, liquidity in shares. That's one thing we said with a minimum 100 million market cap, but sometimes these larger companies may not have liquidity. So that's one of our key things that we can trade in these shares. And we constantly look at the liquidity over 52-week or 30-day average to make sure that we can trade if we wanted to. For all the companies that are in the plan, we get an annual review from PricewaterhouseCoopers, so PwC. And for any new investments that we want to introduce into the plan, we also get PwC to look at it and give us the green light or that comfort that they believe the company would adhere to business relief. We're not traders, we're not churners. We, as I sort of said about Gooch & Housego, we buy and watch. We mature with these businesses, we have a great relationship with these businesses, and hopefully we invest in them, their share price does well for us, and their growth story plays out as why we invest in them in the first place. And then we've gone through our criteria, how we decide the companies we're going to invest in, and then this is our active portfolio management. So minimum diversification, we accept minimum portfolio size of 100,000, and that's 20 stocks. You will get 20 stocks for £100,000. As the value of that portfolio increases to around about 170,000 today, we have a two list, an A list and the B list. And if you have £170,000 with us, you get the full A and B list, which currently is 39 stocks, but we look to around about 40 stocks as maximum. And that's really all companies can own those in the A list, and there's not any difference between the A and B list. Maybe there's better liquidity in those A that we can own for all of the accounts, for smaller and larger accounts. But those B list is really our USP, is that those are our growing companies of tomorrow. They're smaller, they tend to be between 2 and 500 million market cap. So we believe they're the billion market cap companies of tomorrow. So really exciting businesses, really exciting names in good spaces that are going through that evolution of building their market cap, share price, and profits. Every single company has an initial weighting and a weight cap. So initial weighting could be between 2% to 4% or 5%. And if you double that, that's really the weight cap that we look at as initial, and we can reduce it up and down if we so fit. So as soon as a company relative to the portfolio gets nearer the weight cap, we will then trim those profits, such as we've done on YouGov quite a lot this year, and reinvest it into the portfolio to maintain that diversification. And if there is any new companies we listed or included into the plan, those are the companies you'd pick up with that top slicing of those that have done very well for you. As I say, we own quite significant equity stakes in these businesses, between 2 for the very, very large companies to 8, 9, 10% of those smaller companies. So again, as soon as the results come out, we pick up the phone, they answer our call. They want to hear from us. They want to know that they're doing the right things. We're happy with the results. If there's something that doesn't make sense, we'd have that discussion to find out why. So again, us having that communication because they believe in us and shareholders, and ultimately want us to retain us on their shareholder register. We're active, engaged. We talk to them. We make sure we have the telephone call. Even if the results look good, we want to make sure what they're doing next. What's their next 5-year plan? What are they looking at next? Is there another product they're looking at? We want to see the whites of their eyes to see what's keeping them awake at night. Every single question that you ask us, we would ask them as well on your behalf as stewards. So now there's just 2 slides on case studies. So putting everything I've said, the business relief you get, into practice. And this is a real life case study for one of our clients. Mr. C invested 740,000 in February 2017. He was 76 at the time, which is generally the age that our average client is at. Made no additions or withdrawals, so that was fully invested with us for those periods. Unfortunately, he passed away in July 19, and the portfolio was worth 826. So that did very well for him. It was up 12% in those 2 years, or just over 2 years he had the portfolio with us. If you look at the right-hand side first, the no action taken, if you just stuff that under his mattress, excluding any inflation or anything else that's going on currently, that will be taxed at 40%, the IHT payable. So £300,000 of that 740,000 he accumulated will go to the tax man. So the beneficiaries, the net terminal value is 440,000. So it's a significant amount of tax that goes upon death. Whereas if you invested in our plan, your performance has been good, you're up 12%, you've made 830,000, every single penny of that will go to your beneficiaries. That whole amount, the business relief will come through, it will go to your estate. So the net benefit, the difference between these 2 values is stark. 52% of the initial investment, which is obviously the 40% tax break and that 12% performance. So really that 40% tax break is significant. It's a real benefit for us in terms of investing in a name plan, but for the client too, that you have that background or the buffer that you have that 40% tax break on that it doesn't go to the tax man. And putting that into perspective as well, if you owned a discretionary portfolio, so this is a client that you could invest in other sides of it too. So I run through this one as well, and it's a lot of detail, so please bear with me. And this is through the financial crisis of 2008. So Mrs. P invested 50,000 in July 2008. During the peak of the crisis, it dropped down to 32,600, at which point she added another 60K in September 11. So she lost money, she put more money in September 11, And when she passed away in November 2016, the value of that portfolio, so she initially invested 110,000, is now worth 254. So she made a good return in the period she invested with us, just over 130%. And that would fully go to your beneficiaries as well, because I'd adhere to business relief. If that money, however, the same sort of process was invested in the FTSE 100 total return, so the main market, you would get a full return of 62.5% total return, including dividends reinvested. But you would have to pay 40% tax break on that. So actually, taking the 40% off that of that 62.5% on top of your 110 initial, your net to your beneficiaries would be 107. So even though you had that strong performance of 62.5% in the FTSE, your actual net investment, or you're losing £2,800 to the taxman of your initial investments in 2008. So it really is a significant buffer, that 40% break that's currently being awarded to us. So now I'm just going to touch on the team and a few other aspects too in terms of performance and volatility. But Simon Cleaver is the head of the AIM division. He's based in Liverpool. Some of you may know him. He's been around in the small cap space for a very long time. 25 years at 3i in VC and private equity capital raising. Mark Northover is based in Birmingham. He used to run the IHT and EIS offering at Williams de Bro before the merger with Investec in 2011. So again, a wealth of experience there. I'm the relatively new guy on the team. I joined in 2019 from Rathbones. I used to be a discretionary fund manager and have had 10 years in the financial industry before I was the chartered accountant at Ernst & Young. So we have a very good team, a very knowledgeable team. We all look at different aspects. So when we have a discussion on the company, we all look at it from different points of view. I look at it from a financial, technical, accounting point of view, whereas Simon and Mark have the more experience in terms of the business too. So we work very well as a team and criticize a company to the nth degree. But not only that, as Mike sort of said previously, we have a big brand, we have a big firm, a lot of people working in these ancillary roles that assist us. So research, I sit in research in a NOR environment. So I sit alongside other analysts and researchers, and we bounce ideas off each other that they cover some of the companies I investing in likewise. We have an in-house dealing function as well. So we get sort of those direct relationships with brokers to get the best liquidity we can. And the admin capabilities, we've got an excellent back office in IW&I, and that's fully supporting the AIM team too. If you're looking at external research on us, we're on Allen Bridge. I think that's previously MJ Hudson, and we were rated June 2020. There's a new report coming we haven't seen yet. We were rated 87 out of 100, which is we believe the highest of our peer group. We're also available on ARC and MyCup, and data is available there. So let's just touch on performance, and hopefully I'm not running over too much of my allocated time. So just touching on performance, you can see here a number of different time periods. Our IHT plans on the top, and our numbers are net of fees and the mean of the actual life client, so a real life portfolio. And then we've got the FTSE AIM All Share and the FTSE All Share. And these are total returns too on both those indices. And basically we use both indices, one because it's our fishing pond, so the AIM All Share. But the other one is the size of the companies we invest in could be on the FTSE All Share as well. So it's good to see both as a comparative. As everyone's sort of seen, FTSE AIM All Share had a very, very strong year last year. It was up 20-odd%. And that was mainly driven by the high volatility, the high beta names, the recovery type stocks, the hydrogen plays, which don't fit our quality criteria. And the FTSE All Share was a little bit lower, or very similar to what our performance was, and I think that was negative last year. But generally, as I sort of said, it's very much a stock pickers market. So when you look at it from the longer term point of view, our net return of 190% against the AIM All Share of 63 is significant. Our proven sort of criteria, we haven't changed from day dot. Proven criteria works from stock picking those businesses. So we've more than doubled, tripled the performance of the AIM All Share over that time, and basically more than doubled the FTSE All Share over the last 10 years. So us sticking to our knitting, styles and sectors change from year to year, but if we continue to stick to what we do, the quality businesses that we believe in will continue to be there and competitive for the foreseeable. That's how we continue to perform. So then looking at, we've done very, very strong return over the last sort of 10 years and so forth. This slide really looks at that volatility. So one of the learning points I said previously is a higher risk market, but how do you pull a lot of that volatility out of the market? And we really believe it's through our strict criteria and the strict quality company that we invest in. So just looking at the top chart here, sort of give an example of how it works. If you look at this point, I've highlighted on my mouse here between 2013 and 14, that 12 months previous, the IW&I plan made 40% and the two indices made about 20. So it's all previous looking for 12 months at these points of chart. But what I think is really significant on this slide is the average annual return in the bottom left box against the volatility. So just using 10 years as an example, we've roughly made 13% net performance per annum over the last 10 years. The AIM all shares done 6 and the FTSE all shares, just rounding, did 6. But when you can look at it in conjunction that we've done a lot of return, but when you look at it in terms of the risk we've taken absolute terms and standard deviation on returns 14% against the AIM all share at 20. So we've taken basically 70% of the risk of the market, but more than doubled the return. So in terms of a Sharpe ratio per unit of risk, our return is much more superior. But when you look at it against the FTSE all share too, so the FTSE 100, 250 and so forth, we've only taken 20% more risk over 10 years and we've doubled the return. So when you sort of look at AIM as a high risk market of high risk companies, actually there's not a lot more risk than FTSE AIM all share, FTSE all share if you're very selective in the quality that you invest in. And you can get proven there that the returns are far superior, but you don't have to take significant more risks to achieve those returns. This is one for your advisor to talk through, but generally in terms of the charging for our offering, minimum investment 100,000, no maximum. We have lots in the millions and the tens of millions. Annual fee is 1.5%, and that's fully inclusive of our fee. And that the only thing added to that is VAT. No other fees for us, no initial charges, no nothing else apart from a bargain charge per transaction. And again, stamp duty is nil. And we can facilitate recurring fees to advisors as well within our offering too. So I think that covers everything from my point of the presentation. So I will open up to any questions to myself and Mike and Tim, if you have any others that I haven't picked up on along the way.
Adam, I mean, firstly, thank you. In depth, really informative. You know, I think when you get a presentation which talks about not only the benefits of it, and you've really brought that to life superbly, but when you're describing looking in the whites of the eyes of the companies as well concerned. Yeah, I'd open up now to everyone on the call. If you've got any questions for Adam, there is a chat icon, Q&A little symbol at the bottom. Either press the chat button or the Q&A button to get some questions coming through. You did cover a lot of questions that we'd already had through, Adam, so thank you very much from that. But just a couple have come through, and even though I perhaps heard some of the answers, I think they're worth just asking for clarity. Can I transfer over my ISA portfolio into AIM without any restrictions on amount?
Yes. Simple answer, yes. You can transfer an ISA portfolio to us and we can then invest it into the AIM. So it can be invested in anything you want in a discretionary portfolio. If you then decide that actually IHT planning is one of your key concerns currently, and those are assets that obviously are tax-free and capital gains free, we can then reinvest that into AIM quite easily, selling what you currently hold, reinvesting without any tax implications at all. So we can start that 2-year process quite quickly on an AIM transfer, ISA transfer.
Short, sharp, and to the point. Thank you. And on death, there's been a question come through. You know, that if the portfolio themselves are inherited by the beneficiaries, are there strict rules as to what those beneficiaries have to do? I don't want to read too much into the question, but I suppose it looks like it's drawing out. Are those beneficiaries then bound to do certain things, or what are their options?
Yeah, absolutely. A lot of the time that we get, sometimes sort of go through some of the different sort of solutions that comes to us across the desk. The easy one is it gets liquidated to cash, and therefore the beneficiary can do whatever they like with it. They can go back into the state to pay tax, or it can get distributed to the beneficiaries and use. So there's no restrictions in terms of the assets or holding on to those assets. Another solution could be to keep those assets, and if that's sort of cash that you don't need to touch from the person you inherited from, you can continue to hold those assets, and your business relief clock will start from that 2 year as soon as you've inherited upon death. So again, that could be inheritance planning or estate planning for the beneficiary of those assets that have come to you. So yeah, there's sort of two solutions that come across our desk, the two really only solutions that come across our desk in terms of the uses of those assets upon death.
Okay, thanks for that. A question, ESG criteria looks good. If a client wants to avoid other sectors, maybe for example, offline gambling, is there an option to take a stock out of an individual's portfolio? In other words, potentially for them to have influence over what might or might not be included?
Yeah, we do a lot of work on ESG. So mainly if there is such as offline gambling, we wouldn't invest in that company anyway, because we look at the depths of where the revenues come from, in what sectors anyway. So if we're not comfortable as sort of signatories to the UNPRA, we wouldn't invest in these companies. So ultimately, what we're trying to do is that we have a plan. We have a list of 39 companies that all clients will invest in. So if a client didn't want to invest in a particular company, we could look at it, but we generally keep the plan to the plan, because then we monitor everyone's performance. We know where we've invested, and if we have any changes to the portfolio, we can make sure we implement them across all of our clients.
Thanks for that one. You mentioned earlier about the risk, and you gave an example of the risk that was taken versus the indices, and the question that sort of came through was, how much higher risk is the AIM portfolio than perhaps investing direct? And I think you've covered that. But just taking that question one step forward, there can obviously be no guarantee about how similar that risk is, but clearly your outlook is to not take risk where there isn't any necessity to do so.
Absolutely, that's an exercise we're currently going through as well. We update it regularly, but it's looking at, if we're looking to invest in a new company into the plan, we look at the volatility or the risk of the return, which is basically a returns-based volatility of that company, and if it will increase the risk of the plan against the return. So we're constantly looking at the volatility, that if we wanted to reduce the volatility of the plan, we look at companies that have lower risk than the overall portfolio, naturally, to bring the risk of the portfolio down. So again, if we're looking at actually the market's quite buoyant, maybe we should have done a little bit more last year, that adding a little bit more risk but sticking to our quality criteria, we could increase the volatility by adding more volatility companies from a return basis. But in terms of our criteria, that's an interesting point. I'll give you some examples that we don't invest in ASOS or Boohoo. And rationale, basically ESG point of view, if you look at Boohoo, it's all over the press, the Leicester clothing manufacturer that could be classed as slavery or whatever it might be, is currently under investigation. So those are the ESG matters that we do not like. And we're sort of thankful that we didn't own the business during that too. But also the volatility of these companies too. That the volatility of both those is very, very high. Not just because of the news flow that comes out for those, such as ASOS and Boohoo, but also during the peak of the crisis, ASOS went from £40 to £10, bounced back up to £50, and now currently at £38. So again, we don't want to stomach that volatility when we can find other companies in other sectors that we believe are there's more stability in those share prices, or stability in the markets they operate in.
Okay. You did cover this one, but it's come up on a number of occasions, and I'm not sure you get how you can actually answer it any more than you did. But I'm going to ask it again, because again, for clarity, and it's about what happens if the government's stance on relief changes in the future. And I know that this is a question that advisors get on all reliefs that are available, and I previously have heard an answer which is, you can never guarantee it. They tend not to go back retrospectively. But just to sort of put you on the spot to get an answer on that one.
Yeah, absolutely. Again, we believe that anything can happen. They can do something. There's a big black hole that needs to be filled from a COVID bill, ultimately, and tax is the only way really of filling that hole. So there will be other ways of looking at it. I think the sneaky tax that Sunak did in the last budget, which is actually probably a beneficiary to our plan, is the nil rate ban being frozen until 2026. So that nil rate ban when you have a look at it, there are more and more assets with house prices going up and more assets that are going up between now and probably 2026. There's more assets outside of a client's estate. So estate planning now is more and more important than ever before, because there'll be more assets in the taxable implications rather than within the nil rate band. But in terms of the government change, there was a working paper last year, I think it was last year actually, if I recall, yeah, around business relief, and there should be changes to the offering and maybe there will be some changes. Maybe they won't make it as relaxed. You can invest in everything in AIM, but we haven't heard or seen anything that could change drastically for the business relief with an AIM. And I don't think they would change it retrospectively. If you have a client that's invested in AIM, I think they'll still adhere to business relief and still give you the benefit. But maybe going forward, there could be some changes in terms of what we can invest in, or the types of companies. So maybe they'll crack down on the types of investment we can invest in, but not take away the relief in its entirety.
Okay, thanks for that one, because it is a bit of a challenging question to answer. And I'm looking at the next question that's come across. It might be one that's actually more related to the advisors than yourself, Adam. But it's, how much of my money should I consider putting into this kind of arrangement? And it probably crosses us both. And I'd kind of start by saying that I think anybody with estates and assets and portfolios where AIM starts to be put on the table, they should seek advice, and they should go and have that conversation. Anything you'd add to that?
Yeah, anything above the nil rate band that isn't covered with insurance policies or any other inheritance tax planning could be potential assets for AIM. Internally, we have a flowchart that says any assets sort of 10% of the estate, within 10% of the estate could be invested in AIM, which sort of makes sense in terms of, but I guess it all depends on the risk appetite for your clients as well. If you've got generally a low risk client, that they would have lower assets within AIM, because obviously this is a high risk part of their overall holistic portfolio, but they could have a very low sort of lots of cash or very low discretionary portfolio, but still have an AIM proposition and still be low risk generally. So I guess it's all about risk appetite, the amount of money outside that nil rate band, and again the overall net worth of the client, if they can invest excess capital into the AIM market for that benefit.
Yeah. Okay. Thanks, Adam. I'll just say if there's any other questions out there, just get them across on the Q&A. I'm conscious of time. I never like to stop some questions when they're in full flow, because quite clearly they're on people's minds. I'm not seeing any more coming through, so I think it kind of leads us to end there. And I thank you again, Adam, Mike. It is a dry topic, but I think a fascinating topic for those that are, keen and interested on it for varying reasons. If anybody on the call's got any other need for any other information, got any further questions, I'd say please pick up with your integrity advisor. Of course, we'd be more than happy to follow this up with you. I thank Adam and Mike again for their time, and I'd just like to close by saying thank you, all of you, for attending the call and taking time out of your valuable evening to join us. I'm going to go and put the kettle on now and see whether there's a strict heating element, because I've certainly learned something this evening. But just to close, thank you everybody for attending. Thank you, gents, and I hope you enjoy the rest of the evening, and I hope to see some of you soon. Thank you.